Hey, welcome back to The Dive. Today on the show, we're excited to welcome back Lobo Tiggre from the Independent Speculator. Lobo's going to share his thoughts on the November CPI print, the 50 basis point rate hike club and how it impacts the US dollar. He's going to talk a bit about the government not focusing enough on oil supply issues, lithium, copper, gold, and he's going to give us his thoughts on tax loss season. Hey Lobo, welcome back to The Dive.
Hi, Cassandra. Glad to be back with you.
Yeah, we're so happy to have you back. Okay, so let's start off with the November US CPI print coming in at 7.1%, the biggest decline since April 2020. Where do you think that the Fed will go from here?
Well, we've also had a Fed decision, and we won't have another one until February. So we have some input on this right now. But first, let me back up to the CPI thing. The biggest decline since this. We have so many headlines like this. Biden, the largest number of jobs created. Well, yeah, that's after the largest number of jobs destroyed. So of course, there's these outsized numbers. We've had, this monstrous surge in inflation coming, very suddenly, except to everybody who understands monetary theory, which apparently nobody at the Fed does. But of course, that creates large base effects. So you have, big adjustments. So, these numbers, and you'll hear, and I'm not just hopefully just flogging a hobby horse here, but dear audience, keep this in mind. You'll hear these numbers about record this, record that. Well, in a time when you're in uncharted waters and records are being broken left and right, of course, that applies to the rebounds and everything else. It's that word. I don't think it means what you think it does. Anyway, but the question is, where does the Fed go from here? And it's interesting that we got the Fed's decision, which was pretty much what was expected, 50 basis points, higher for longer. But to me, the most interesting part about that was the reporters asking Powell their questions after the release. And that's always when the fireworks occur anyway. But it was kind of like the reporters not really calling BS on him, but really pushing back. And we got this CPI number that was much lower. There's all these signs of potential recession. And you're saying there's still no recession, are you going to lighten up? And Powell was pretty firm in saying, no, we're going to stay the course. Now, just because he says that doesn't mean they'll do it. They do have a dual mandate, and he always says we'll be data dependent. But for whatever it's worth, it's really significant that, they're saying, that interest rates are going to go over 5% in 2023, and they're going to stay over 4% in 2024. That is a lot more aggressive than the market is pricing in. So I can't tell you, Cassandra, or dear audience, what the Fed will do. I don't think the Fed even knows what they will do for sure. But this is something worth watching out for. Less so much on what the Fed does, because their function is a reaction function, but on what the inflation does. Because if it doesn't come down as much as everybody seems to think it will, even guys like Jeff Gundlach, who are very critical of the Fed or have been in the past, are thinking that inflation is going to come down to 4% all on its own. In which case, the Fed's rate would be highly restrictive this coming year. So we do need to watch this. My outlook is that inflation will be stickier than the mainstream is thinking, higher for longer on inflation. And that will change the equation, the reaction function for the Fed, and all these investment assumptions that everybody in the mainstream is making. That was kind of a mouthful, but, when you ask me to be a Fed whisperer, that's all I could say is, they're data dependent, so we need to be too, but I expect things to not go according to plan, and therefore we should, buckle up and get ready for that.
Now, the Dow, S&P, and NASDAQ fell after Jerome Powell signaled that more data was needed before the central bank would change its view on inflation. How long do you think that this trend is going to continue?
I think that we're actually in for a bear market for stocks for some years. I think there's potential that we may have just gone through one of those, seismic types tidal shifts where you have commodities going down and stocks going up for some years or decades, and then they reverse. Commodities and equities tend to be contracyclical. We may have just gotten to one of those inflection points where equities just generally have a crappy time for the next several years. I think that's a highly technical description there. But even if I'm wrong about that, I do think that we are looking at a global recession. I do think the U.S. will not be exempt. I do think that the earnings impact of that has yet to be priced in by the markets. So the minimum I'm looking at is lower prices in general for equities throughout 2023. If the Fed pivots or fiscal policy comes in, whatever the Fed does, if Congress starts sending out more checks to people, that could actually turn about by the end of next year. But before it does, I think the pain will have to get worse, especially with Republicans controlling the House. Not that I think that the Republicans are better at spending or not spending than the Democrats, but just because they want to be obstinate and throw a wrench in the gears that the Democrats want to try to push. So, yeah, I think we're in for pain in 2023. I think that's not priced in. So I think in general, equities have a lot more lower to go, even without some, momentous 1929 or 2008 style crash. I do think they're headed lower.
The Swiss National Bank, Bank of England, and the European Central Bank joined the 50 basis point hike club this week. What impact do you think that this will have on the US dollar?
Well, that was probably the most disappointing news to me of the week. And that's me being partisan, I guess, because I was rather hoping that the Fed would lighten up more or sooner than its counterparts. And they often are not in sync. It's not like there's a secret meeting of central bankers and they all plan to have the same interest rate, each time, and they march in lockstep. In fact, it's more often than not, we hear complaints from European central bankers and others that the Fed isn't towing the line, that the Fed is doing something different from what everybody else is doing. Nowadays, that seems to be Japan's role. But at any rate, I was kind of hoping that the European banks would sound a more hawkish note, because then that would make the Fed seem looser, and that would make the dollar at least appear less strong going forward. And most of the things that our audience care about, not just gold, but commodities, resources in general, being priced in dollars, would benefit from a weaker DXY, even though, there's a long story about the DXY. I call it the wrong trousers. It's certainly the wrong measure for the gold-dollar exchange ratio. But there it is. It's what the traders look at. So right now, had the European bank sounded a more hawkish tone than the Fed, it would have, I think, boosted the euro and gold and other alternatives to the dollar. Didn't happen this time. But impact-wise, it's interesting. We have people talking about peak inflation, not just here in the U.S., but in Europe too. It's down in the U.K. to just 10.7%. I mean, that is so ruinously high. It tells you about the rock and the hard place the central bankers are in. I think it's way too soon to declare victory on inflation in Europe, and for the central banks there to moderate even a little bit, I think is hopeful. Maybe they're right. Maybe the base effects will cause inflation to continue to moderate over there. But remember, a decrease and an increase is not the same as a decrease. It's still going up. It's still way too high. And if they get too easy too quick, then they will be doing the very thing that the central bankers in the U.S. did in the 1970s that exacerbated that famous situation. The very thing that Powell is trying to avoid when he cites the 70s and invokes the ghost of Paul Volcker. All the central bankers are aware of this risk. And I think the Europeans are skirting closer to making that mistake with their action this week. We'll see. You might ask, maybe you won't, but maybe you would ask, well, what would you do, Lobo? Well, if somebody made me a central banker, the first thing I'd do would be quit, because there's no winning on this. There's no good solution. I don't think you're going to cause pain one way or the other. But ultimately, philosophically, I think the market should set interest rates, not governments. And I know that would create a huge liquidation and other pain, but ultimately you would set honest prices and get, it would make stock prices react more to the actual earnings of companies and their merits in real world terms rather than what the Fed's going to do or what the ECB is going to do. That's the world we're in now.
Do you think oil is the main driver of inflation over the short to medium term? And do you think that governments are focused enough on solving oil supply issues?
No and no. I think that oil is certainly a contributor, but I think at heart, I agree with the Friedman dictum that inflation is always and everywhere a monetary phenomenon. That's the root driver. We had huge money increases in response to the COVID lockdowns, so we had huge inflation. That's no surprise to me. Long and variable lags is the other part of that equation. The oil situation certainly doesn't help, and I do think it is contributing, and I do think it will continue. I think the important thing here is it's not just, this Ukrainian problem or even this European problem. There's a new Iron Curtain going up all around the world. I think you and I have spoken about this before. And even if the war ended somehow, some negotiated thing, absent a regime change in Russia, I just don't see that new Iron Curtain going away. And even if you did have regime change in Russia, China's still on the other side from the West, broadly speaking, of this new Iron Curtain. So I don't see it going entirely away under any conceivable circumstance. And I do see it raising prices, partly through oil that does impact things. If you have the main source of energy in the world cost more to produce, it's going to have trickle-down costs impacting everything else. Energy goes into everything you do. Even if you're a basket weaver somewhere in the jungle, you still consume energy to keep your own life going. So higher energy prices, of course that matters. Of course that has to be passed on into the products made with energy, any products. So I do see this as a contributing factor to permanently higher prices. So even if the base effects go away, even if the powers that be succeed at destroying enough demand to offset all the money that they've printed, I still think you're going to have higher energy prices for a long time. And on top of that, you've got the whole green agenda. If you're going to replace cheaper forms of energy with more expensive forms of energy, well, guess what? Energy is going to cost more. And things made with energy, which is basically everything, is going to cost more. So I do see this as, if not in and of itself the game changer, then a one-way doorway that the world economy has just gone through to a permanently higher energy price paradigm, which, other things being equal, would make for higher everything prices. You need a lot of productivity increases in other areas to offset higher energy prices.
Now, shifting to battery metals, last week the European Commission was set to give a final ruling on whether lithium should be classified as a toxic substance, but the decision was pushed back into the new year. If lithium is labeled toxic, what effect do you think that this has on the market?
Lithium is a medication, amongst other things. It's a lubricant. It's actually pretty ubiquitous. And for political reasons, it's just become this huge football. I remember the protesters in Serbia when when Rio Tinto, one of the biggest mining companies in the world, wanted to develop a large lithium resource in Serbia. There was all this misinformation out there, which I think was politically driven, but they talked about how lithium is like the most polluting kind of mining in the world. No, it's not. There are plenty of things that are much more toxic in and of themselves than lithium, and the production of them is potentially much more dangerous, environmentally questionable. I understand that if you don't want to mine in your backyard, you're going to do what you can to oppose it. But things that are just simply not true have been introduced into public discourse on this subject that are, they would be laughable if the matter wasn't so serious. So, we'll see. On the one hand, there's probably some political favor to be won by jumping on this anti-mineral bandwagon. On the other hand, for now at least, lithium is essential to the electrification story. Lithium is supposedly one of the good guys. It's one of these green minerals that we all want. So, the woke politicians are going to have to decide, which supporters they're going to piss off and which ones they're going to favor, because you can't have it both ways. You can't have electric cars without lithium right now. I mean, maybe 10 years from now, it'll all be hydrogen. But there's a long way before that can happen. There's barely enough charging stations for the electric cars on the road now, let alone the ones they want. There's basically no hydrogen infrastructure to speak of on any large scale. So, they keep banning everything. Pretty soon, they're going to ban oxygen because too much of that will kill you.
What effect do you think that this has on the market?
Well, I mean, it'd have to happen. There would have to be a ban. And, I guess my guess will be minimal. I think if not reason, then at least some balance of greed will prevail, because this is just insane. So I would guess that it's probably not going to impact the lithium market that much. The bigger question about lithium really isn't, increased regulation of it. It's the current supply already needing to ramp up and keep up. There's this question of whether it will keep up. Lithium is not rare. There's plenty of lithium in the world. At the right price, you can mine tons of it. But it takes time to bring these mines online. So there's large numbers of known resources of lithium all around the world, but few of them are permitted to go into production. And it doesn't help if the EU is going to talk about lithium as being a toxic substance. If you make the permitting regime that much more difficult, then that could create, more scarcity than really is necessary. And that could push lithium prices higher. Or it could go the other way. Some politician could step in with something like Operation Warp Speed. Got to save the planet. We need more lithium batteries. And they could open the permitting floodgates to get more lithium mines online quick. I mean, we know where they are. There's no problem of needing to find more lithium. It's a matter of being able to produce it on scale in order to meet the increasing demand. And sorry, but one more thing to throw in here, one more monkey wrench is, I also started out by saying that I'm expecting a global recession. I think it's probably started already, but certainly it will be called the recession of 2023. Not certainly. I think it will be called the recession of 2023. And electric cars are more expensive than their gas counterparts. So I could actually see, even though the EV demand has been ramping up faster than most critics expected, I could see it cooling dramatically in 2023. And that might create some breathing room for the lithium miners to catch up with the demand scenario here. So it'd be interesting. I don't know which way that will pan out. I think it's a mistake really for either side to say, oh, there's going to be too much lithium, or, oh, there's going to be not enough lithium. If you look at the preponderance of projections, boy, that was a mouthful. But if you look at, the different experts saying different things, the line's going like this, most of them have supply and demand somewhat close, fairly balanced for about 5 years. And then after 2027, things get really dicey. So not one variable here, Cassie, sorry, but lithium, I've been looking into this for months with the team because we were hoping to come out with our own projection. It just turns out to be really complicated. There's a lot going on here. And there are a lot of sort of external shocks and variables that could completely change the answer like that.
Okay, well, let's move on and talk about copper. Goldman Sachs and Bank of America said that copper could hit record highs in the coming year. What are your thoughts on this? And what do you think will drive copper to its all-time highs?
Well, as the audience surely knows, it's been called Dr. Copper from decades because it's a vital industrial mineral, and it was before this whole green agenda came along. So on top of that, you have this new usage which can multiply demand. And by the way, even if there are other automotive technologies, hydrogen cars, other solutions besides just the lithium batteries, you still need a lot of copper for all the electrification that goes around it. All the solar panels need to be wired. So it's it would be a mistake to put copper and lithium in exactly the same basket. I think, longer term, I actually think copper has a brighter future than lithium. So that's the good news, is I am actually quite bullish. I agree with these sources that there's visibly a supply cliff coming in copper. Now, different experts here disagree as well. There are quite a few that think that there could be balance or even a slight surplus in 2023. And then after that, the market will go into deficit. There are others that see that right now, and that 2023 it goes into deficit. The question about the recession comes back again. It might be that there would have been a deficit in 2023, but if the global recession hits hard and a lot of industries pull back, we could see less demand. We could see fewer people buying EVs, but even of conventional copper demand, you could see that pull back as well. So in the near term, I have to tell you, like longer term, copper is one of my very favorite stories. I've said this is the sort of thing that if you could find a great company that you're not worried about its, survivability come, short-term fluctuations, sort of thing, you could buy the stock, stick it in a drawer, forget about it for 5 or 10 years. You probably come out ahead if you got a quality stock pick. But that's not to say that it won't go lower in the near term. Right now, I'm not buying any copper stories or stocks at all. I'm totally on hold on that because experience has shown us that even for metals that are in short supply, it doesn't matter. When there's a recession that hits, everybody, there's just like this emotional gut reaction. They stop buying industrial metals. Or the traders who set the prices on the LME or other markets, they just have this instinctual reaction and the spot price drops. So I think with my recession call, I have to say near term, I'm absolutely not a buyer of anything copper based at all right now. I could be wrong, so I'm not selling any of the copper stocks that I have in my portfolio right now, but I'm definitely not looking to add, at least not until we know how bad this recession is going to be and when the scare is in. Once that's in, maybe these stocks I talk about that you could own for 10 years and not worry about, if I can get them for 50% off, waiting 3 or 6 months, well, that's a good deal. Not really trying to time the market here, but right now, that risk to the downside ahead looks real and maybe an opportunity worth waiting for.
What about gold? What is your read on the price action of the gold chart?
Gold seems to be doing pretty much what it's been doing all year. Now, if you're one of these people that just can't wait for it to go up to 3,000 and then higher, that's not good. That's disappointing. But I think objectively, if you think about the headwinds that gold has faced, not traditionally, it's not the right word, but historically, since 1971, when the U.S. completely abandoned the gold standard and the price was free to move, the number one explanatory variable has been real interest rates. And real interest rates have been rising. The directional change was several months ago. The 75 basis point hikes that the Fed and even other central banks have put in, that is a real and material impact on you subtract the nominal inflation rate and the interest rate, you get these real rates. And those they're still negative, but they're less negative. And that directional change matters. So to have gold still around 1,800 in this environment is actually quite good. On top of that, you've also had a year when, for the most part, the dollar has been surging. So that's the other, main variable. Why is interest rates so important? Because in theory, they tell you where the dollar is going. Markets are forward-looking, and gold is priced in dollars. And so that's why, the dollar itself isn't usually the direct inverse correlation with gold is the interest rate because markets are forward-looking. But this year, you've had gold trading pretty much directly inversely with the dollar on a day-to-day, week-to-week basis, moment to moment. When the Fed makes its announcement, you'll see the dollar go like this or like that. You'll see gold doing the opposite. So to have the dollar have such a strong year and have gold more or less hold even there around 1,800 is actually outperformance. And of course, if you look at gold price and everything else but the dollar, you look at it in, other currencies, gold is at or near record highs in many of them. So gold in terms of being something that's real, of value, a physical asset that you can hold in your hand. As my friend Doug Casey likes to say, it's the long for which there is no short, right? To have that hold up in the face of these headwinds that normally would be very bearish for the price of gold, I think is actually good. That's telling us that there's people out there, there's appetite out there, there's buyers out there that get it, that all is not well in Mudville, that even if we have, the peak in the increase of inflation, that doesn't mean all is well. 7.1% is still ruinously high, never mind 10.7% over there across the pond. So I'm quite bullish still on gold and silver, which I do still see as a monetary metal. I had been, again, not trying to time the market exactly, but I had been more concerned about a market crash or a waterfall event that would put everything on sale, including gold. And so I kind of held back a bit since this summer. Didn't happen, but prices for the stocks sure went down. And so it actually worked out pretty well to be able to hold off and then start buying more recently. Long story short, I'm very bullish on gold and silver going forward. I think that the recession that has me worried about copper and industrial minerals in 2023 could actually boost safe haven demand for gold and silver. So I'm not so worried about them. And I do think they have the chance, if, this inflation turns out to be stickier, higher and longer than the mainstream is expecting, as I think it will, but that would really fan the flames under gold and silver. So I am back in the buyer's camp at gold and silver. I was kind of hoping tax law season here would help us out with some bargains, but it looks like whoever was going to do that bought already. Not a lot of bargains out there. Or rather, things haven't gone even more deeper on discount than they already were. So I'm back in the buyer's camp for gold and silver right now.
What do you think needs to happen for gold to make another significant move?
Well, needs to happen or will happen. There are several variables. I think if we go back to what we were saying earlier about the central banks and what they're doing, the Fed led the way in the tightening. And even though right now, as we speak, everybody and their cousin is going to the 50 basis points club, if the Fed leads the way in loosening, we could see the dollar go down as other central banks are perceived to be tighter. And if that happens, that should be very bullish for gold. This could happen in, like next month. And that would be significant. Probably not a game changer or something, but directionally, that could matter. I mean, that sort of thing is what brought gold back up to 1,800 when it had flirted with lower prices a couple months ago. So that could certainly help us again. The bigger variable I'm looking at actually is this inflation expectations thing. We already have signs of a recession. We already have high inflation. Even if it's coming down, nominally at least, it's still very high. So I say that we already have stagflation. And then people say, well, no, in the 1970s stagflation, gold and silver went to the moon. What's wrong? Well, in the 1970s stagflation, that did become entrenched, and people did expect prices to be going up. People would stock up on toilet paper or anything that you could buy that wouldn't go bad. It made sense to buy more of and buy it sooner because the prices would be higher in the future. Quotes, everybody knew this. And that impacted the demand for other things that don't inflate, like gold. So that's missing this time. This time, if you ask everybody, or at least the consumer surveys, the consumer isn't very happy about inflation in the near term over the next year, but they're still not terribly afraid of it. They think it's coming down. And longer term, they think it's going back to normal, that the Fed is going to beat inflation. And so this is very different from the 70s. It's not this near panic mentality. Not panic isn't the right word, but this certainty that people had, that it made sense. It was wise. It was a smart thing to do, to dump your dollars as fast as you could into any alternatives, goods or gold, something else, because your dollars were becoming worth less over time. That's not present this time. And I think there's a pretty good chance, if I'm right about stickier inflation, higher for longer, applying more to inflation than to interest rates, then that psychology is the missing ingredient that could really light a fire under gold and silver this time. And if that's right, I think we will likely see that in 2023.
So, Lobo, we are subscribed to your Speculator's Digest, and one of your most recent articles titled Tax Loss Season caught our attention. Could you give us some color on this before we let you go?
This is one of those things that different countries have different rules for this, but in the US, you can sell a stock and take a loss on it. And if you're underwater, sell it, take the loss, and offset your gains on other stocks. You present your sort of portfolio of total gains to the tax authorities. So if you have some big wins in other areas and you have a loss or two here and there, then you, even if you like that company, even if you think that it's going to come back, you can sell it, take the loss, offset your gains, reduce your tax burden, and then later on buy the stock back again. There's a rule on that. In the U.S., you got to wait a month. If you sell the stock, book the loss, and then turn around the next day and buy it again, they don't really consider that, a tax loss. So you got to wait. So this tends to happen in December. At the end of the year, people are looking at their portfolios, looking at their tax obligations going forward, and they will book losses for the specific purpose of harvesting them for tax offsets. With the mining sector, this seems to happen, with a vengeance whenever the stocks are down. So it's something that, gold stock investors and others are well aware of. This year, many of the mining stocks are down, from over their last year and over the course of the year, steadily down. So you would think this would be a year in which there would be a lot of tax loss selling. However, the broader markets are down. Lots of things are down. The energy sector as a whole is up, but not all the stocks are, and few people invest in energy only. If you were an almost pure energy investor and had a few gold stocks, well, hey, you might have some gains to take some losses to offset. But that's not most people. So we've actually seen, I think, less tax loss selling this year than normal. And I think that's because fewer people have gains to offset. And another point, I have to give credit where due. My friend Adrian Day was the one who pointed this out, is that if instead of just, those core gold stocks being all beat up and everybody, taking tax losses on their gold stocks because that's what's down, a lot of things are down. You've got bigger losses if you own Tesla or some of these market darlings. So they could be seeing more tax loss sellings than our commodities stocks, especially with, even Goldman Sachs and Bank of America talking bullish about commodities. So, yeah, I mean, earlier this year, I thought there was going to be a greater risk, and I had actually made a shopping list specifically for tax loss season, and hasn't worked out too well, But as a person who's long, I'm okay, Actually, one last quick point on this: when gold came back up to 1,800 in recent weeks, and we saw the gold stocks moving with gusto, I think anybody that was thinking of taking tax losses on their metals and mining stocks, that they tend to move in sympathy, and we saw other metals move as well. I think a lot of those people took their tax losses early. They saw this ramp up in share prices, and they said, this is my chance to get out. A tax loss is good for offsetting a gain, but a loss is still a loss. You don't want to make the loss as big as you can. You still want to minimize your losses. So, yeah, I wish I could tell you as we're recording this, this is great tax loss season. This is bargain hunting season. Unfortunately, for anybody who's looking to buy, that doesn't seem to be the case. So the takeaway, though, there is that if you have been waiting to buy, don't wait for a last moment tax loss bargain. That's not likely to come. If there's something that you like, it's at a price, let's say that's lower than it was a few months ago, maybe not as low as it was in recent weeks, but it's still lower than a price that you thought was good before, well, I wouldn't be too, curmudgeonly about pinching the pennies on your entry point.
Okay, well, Lobo, that's all we have for you today. And thank you so much for coming on and always being so generous with us with your time throughout the year. We wish you Merry Christmas, Happy Holidays, whatever you celebrate, and we will see you in the new year, hopefully.
All right. Well, thank you very much, Cassandra. And despite tax loss season giving us a skip, it is the holiday season. So, whatever holidays you celebrate, got a new year coming ahead, lots to look forward to. So I wish everybody a happy one with their loved ones. And for what it's worth, I don't like making these big crystal ball predictions, but I'm actually quite optimistic for resources in 2023. Industrial ones, not in the first half, Monetary metals, excited. In uranium, we did talk about that. It's different. I'm excited about that in the near term as well. But farther ahead, we've got China reopening. We've got fiscal and possibly monetary pivots. So I'm really quite bullish on the whole resource sector in due course. So I hope everybody has a happy one.
Thank you so much for watching today. We will be back again tomorrow with the latest news and updates. So be sure to hit that little bell before you leave so you don't miss out. Bye.